the quantum moves that we've seen in the silver market, the moves from $4 to $50, or in the 70s from $1.20 to $50, have come as a consequence. I think the gold-silver ratio is a factoid. I think it's important only because the market thinks it's important. Think this through. People say that the ratios should be 16 to 1, which reflects the relative abundance or scarcity of both commodities in the Earth's surface, relative to 100 to 1, which is the price differential. But why should price be a function necessarily of supply or scarcity when it doesn't consider utility and it doesn't consider cost of production? With silver, as an example, about 18% of the world's supply of silver comes from silver mines. The rest comes as a byproduct of mining other metals or as a consequence of recycling. What that means is that the production cost around silver is a minor impact, a minor part of the supply-demand equation. Look, too, at the massive above-ground holdings of silver in private hands. Most of the gold that's held publicly is held in public hands, which is to say in government hands. But silver is controlled in private hands, which makes it much more difficult to measure. In my experience, industrial supply and demand in silver has been interesting, but the quantum moves that we've seen in the silver market, the moves from $4 to $50, or in the 70s from $1.20 to $50, have come as a consequence of overwhelming investment demand. That's happened 3 times in my life. I've seen better than tenfold moves in silver bullion 3 times in my life, and none of them accompanied increases in industrial materials markets. My experience has been that precious metals bull markets are led by gold. Eventually, and we're seeing that right now, leadership changes from the bullion to the highest quality gold stocks. Later, leadership changes to the mid-tier gold stocks. When the momentum in the precious metals markets lends credence to the precious metals narrative, and the generalist investor comes into the precious metal space, perhaps because of silver's lower unit cost, making it more affordable, or perhaps because of its reputation for upside volatility, or perhaps both, the generalist investor, particularly the speculator, becomes attracted to silver. And the leadership in the market changes from gold to silver. Steve, when that happens, you won't need Rick Rule to tell you what's happening. It will be very dramatic. It will be very, very, very apparent. But I'd pay less attention to the gold-silver ratio, and I'd even pay less attention to the utility generated by silver in the industrial market. And I would pay much more attention to the traditional dynamics around investor and speculative demand in precious metals markets and the history of the price action in those markets. Well, I would say that for the Tier 1 boot camp, 100 million ounces of silver probably puts you in strong Tier 2.
Okay.
Understand that we want minimally $10 million in situ recoverable reserves and resources, but we would prefer $20 billion in situ recoverable reserves and resources. Now, big silver deposits, well, in fact, economic silver deposits are extremely rare. So speculators can be a little more generous in the silver side. We've talked before, you'll remember the Silver Boot Camp, where I think we were able to establish that the market capitalization of legitimate silver juniors is so small that when the generalist investor is tempted down into the silver space, there isn't sufficient market cap to handle the money. These are the most volatile financial instruments in the resource business. If I take myself back to the decade of the 70s, I remember the shares of Coeur d'Alene Mines going from 10 cents to $65. That's not a typo. I was too young, too poor, and too dumb to take advantage of that. But I also remember a wonderful small silver bull market that we had at the beginning of the 1990s. I remember Pan American Silver going from 50 cents, where we had the good fortune to underwrite them, to $45 in 6 or 7 short years. I remember Silver Standard Resources under Bob Quartermain's stewardship going from $72 cents to $45. The point of all this is that Cerro de Pasco is part of a fairly small club. of legitimate silver juniors with reserves and resources exceeding 100 million ounces, where when the generalist investor comes down into the precious metal space, I should say if, not when. If the generalist investor comes down to the precious metals space, these things can exhibit almost unbelievable upside. The people who buy these things in good markets are not the people who attend the Ruhl classroom. These are people where if the silver price goes from $30 to $90 or $100, they believe that trend is going to continue on indefinitely. They are people who buy narrative, not fact. You need to be in these markets before they get there. They need to be your exit strategy. I don't know. What I said was that according to JP Morgan Chase, not Rick Ruhl, that the market share of precious metals and precious metals related investments in the US market was 0.5%, which is to say, if you added all the savings and investment assets in the United States, less than 0.5% of total private savings and investments is in precious metals and precious metals related securities. If you look back over 40 years, according to JP Morgan Chase, the mean market share of precious metals over 40 years has been 2%. So the statement was that if interest in precious metals returned and the market share wouldn't need to go to any dramatic place. It wouldn't need to be a circumstance where gold eclipsed the Dow or the death of the US dollar or any of that normal gold buck stuff. All that needs to happen is that we need to return to historical mean. If we return to the historical mean, then demand for the stuff grows fourfold. Remember that prices are set on the margin between supply and demand, not across the entire chain. I don't know what that would happen. I don't know what would happen to the gold price in that circumstance. I suspect I'll find out. A few interesting things. First, the deliberate failed attempt in this case by the Fed and the political class to lower the interest rates has been interesting for many reasons. Even their measure of inflation, the CPI, which I, by the way, call the CP-lie, has been stubbornly high, and they have been unable to lower the interest rates. But much more interestingly, despite some success in the short treasury, in short-dated interest rates, the long-dated interest rates continue to climb. And the long-dated interest rates continue to climb even in the face of fears of the overall economy. The so-called flight to value isn't occurring in the US 20. It isn't occurring in the US 30. The dichotomy in interest rates between the soft short rate and the very, very, very strong long rate is saying, I think, or perhaps at least, that the Fed is beginning to lose control of the interest rate battle. That fears about the declining purchasing power of the US dollar are beginning to overwhelm the attempts of the Fed to manipulate the interest rate lower. If this is true, this is a shadow of 1975. It's something that I have seen before, and it has profound implications for debt markets, for equity markets, and in particular, for precious metals markets. We're seeing something else too, Steve, evidence of a dramatically slowing economy. I don't think there's any doubt about where I stand with regards to tariffs. Tariffs are taxes, and taxes are bad. But we are starting to see the impact of trade uncertainty. We're starting to see the impact of economic nationalism, not in the United States necessarily or solely, but around the world. And what we're starting to see is that the economy is slowing. The precipitous decline in the oil price had nothing to do with an increase in oil production. We haven't seen that. It's had to do with a reduction in oil demand. And that is a wonderful sign of a soft economy. We are now coming into a period where interest rates would appear to be strong, at least on the long end of the curve, in response to inflation. But even despite inflation, the economy is softening, which is to say the inflation isn't occurring on the demand side. It's occurring somewhere else. They had a name for this in the 1970s. It was called stagflation. It was not pretty. Those of us who paid attention got through it handsomely. Those who didn't got punished severely. It's our job at the Rural Classroom to help you be one of those who get through it healthily rather than otherwise. We talked, Steve, the last time you and I visited on the Classroom about the arithmetic behind this, and the arithmetic behind this is fairly stark. We talked about the on-balance sheet obligations of the U.S. government, the off-balance sheet obligations of the U.S. government, and the fact that the last time